In this video, we're going to be showing you how you can trade a stock short bias, even if the shares are either not available to borrow or if they're just hard to borrow. Because again, shorting stocks, if they're hard to borrow, can be expensive. You usually have to pay fees on that. So again, cannot be ideal. And usually if they're not available to borrow, they are potentially vulnerable to a short squeeze, which again, you probably don't want to be in for anyway. And again, if they're not available to borrow, you're probably not getting any to borrow. So there's still a way we can still profit off this. And I'm going to use GameStop as an example because I used this one actually myself when we had the massive move in 2021. And it's going to the option chain. So again, it has to be, you probably can't do this on like the really small cap stocks, which are up 100% in a day, because most of them don't have options. They need options to be able to do it. But what you would do is you put in obviously the ticker over here, you go down to the option chain, and then what you want to start doing is going out. Usually I like to go out at least a month, but usually looking in about a 1 to 3 month time frame. So for this example, why don't we go out 55 days, so basically 2 months. What you would do is then open up that option chain, and then obviously we can see the strikes down here. Now what I would do is go over to spread, change this to vertical. Now what this will show you is vertical spreads. You may also have heard them as credit or debit spreads. So again, we'll go through what these are. But what we can now do, so let's say GameStop right now, obviously it's not extremely overbought, but let's say it was at $23. This was overbought. We want to play it to the downside, but we can't get shares available, or it's not an easy to borrow stock. Let's say we know it's basically going to start trading below $22. So let's say that's our plan. What we can then do is come over to the vertical spreads. We can look at the puts, and then what we can do is we left click on the ask, because this will buy the put. And then what we can see is this is looking at a $22 and $21 strike. So what we will do is analyze this, because this will make everything a lot clearer. And again, even if you're trading yourself, you probably want to go through the analyze tab just so you can get a clear instance of what your risk to reward is and what strikes you want to be paying attention to. So what we can see right now is, in this case, if GameStop keeps going against us and it kept going higher, we would lose $47 no matter how high it goes. Anything above $21.50, again, we start to lose money. Anything above $22 is our max loss of $47. On the other hand, if we start going to the downside, we can see we got a max reward of $53. So if it goes to $21 or below, we get our max win. Now that is one thing to note with this strategy. Trading it like this gives you a defined risk, but also defined upside. So with this, again, if GameStop was say at $300 and you do this, you're still probably, you're still getting the defined risk, and you're still probably only getting about a 1-to-1. Normally, most of the time, these are 1-to-1 risk to rewards. So that's one thing to note. So sometimes you may just want to go in with a bit more size, because again, you can just add size if you still know what your defined risk is. But again, your risk and reward is always going to be defined. So we can see that's what we're looking at. Now let's say, cool, we're still sitting around that $22, $23 mark, or right now we're actually sitting at 23. So what we could do is change that to 23. And now what we can see is, how does this affect our options? We can see we're still risking $99 to make 101. So again, then we can say, okay, we think it's actually going to go a bit lower. We could say $20. Now what we can see is we're risking $144 to make 156. So in most of these cases, it probably doesn't make sense to be adjusting it. But again, you want to flick through these strikes, see where does it make sense. Sometimes you could get a better risk to reward by still trading within a range that you expect it to trade within. So that's one way to be looking at playing it. That's called a debit spread. And again, if you're looking at debit, you're looking at the stock or the option direction to be the way you're basically playing. So in this case, we're looking to buy puts. So we're looking at a debit. Now, if we want to play it bearishly, again, we can. And there's one other way to do this. And this is by changing these to a call. And now what you can see is we basically get the same trade plan. And by turning it into a credit, again, this sometimes it won't matter what one you do. But sometimes in the options, you may be better off trading a credit spread. Sometimes you're better off playing a debit spread. So it will really just depend. And in this case, we can see you're actually worse off playing the credit spread. You can see it would cost us you receive $97, so your max win is $97, but your max loss is still 103. So in this case, it would make sense to a debit spread, but again, you can adjust the strikes around to potentially make it more beneficial. So again, that when you're doing this kind of strategy, it's a lot of playing around, seeing kind of what is your best risk to reward, where can you make the most money with the least amount of risk. But again, this is kind of how you can do it. So in this case, again, credit spreads are going to be a bit different than debit spreads, and that's because with the credit, you get paid today. So if we sold this right now, we would get paid for example, $41 to sell this. And then what it means is we don't know if we lose the money until the expiration. So in this case, 21st of July. If at the 21st of July, we're above kind of $23 or above our strike of $22.50, we're going to lose money all the way up to $59. Now, again, obviously what you would actually pay out is $100, but you've received $41 today, so it makes your max risk actually $59. And on the other hand, if coming into expiration, it's a profitable trade, it's below $22, you don't, basically nothing happens, you just keep your $41. So this is one way to be looking at trading it, again, especially if they're hard to borrow. And basically you just don't want to trade the shares. And again, sometimes you may get some shares available to short, but obviously then that uses a lot more margin. You've got to short the shares, and then you've also got to buy the call as a hedge. So sometimes that can use a lot more margin. So using a way like this, you know, your margin is basically going to be the difference between the strikes, sometimes a bit less. So again, it's going to really use a lot less margin. So another way you can play it if maybe you got a smaller account. But again, the overall thing is if it's an extremely overbought stock, you can really catch those peaks with a strategy like this. And again, then you also don't have the time problem. Again, you can pick your expiration of 60 days. They're most likely not going to trade irrational for 60 days. It will probably come back below within that time. So again, you can get a really high success rate with a strategy like this. So this is another way to be trading these short bias stocks at extreme highs if you can't short the share. So I hope you enjoyed the video. If you did, why not drop a like and subscribe and check out this video here.